Hello, this is Joe Hoyle. It's Tuesday evening, about 9 o'clock right now. And because of the bad weather outside, the 9 o'clock class on Wednesday has been canceled. I know some of you are going to try to go to the 10:30 or 1:30 class, but we have very few seats in those situations. So I think this video will do perfectly well to cover everything we're going to cover on Wednesday's class. I must have done a gazillion of these during the pandemic, and I thought they were great. I thought this is a wonderful way to have a very strong education because you watch the video as many times as you would like. So I think this will be fine. I'm going to share my screen, and I've done this now a few times. And since the last time I did Zoom, they changed some of the buttons, and so I've had a few situations that didn't go very well, but I think I'm ready to get it right this time. So it's going to work. Um, this course is the class for February 12th, 2025. That's Wednesday's class. I have added office hours for Thursday. I'll be there from 11 to 11:45 and from 1 until 2 because since we're having this kind of turbulence, I want to give you a little bit more time to come by my office. And so my office hours on Thursday have been extended. You can always email me questions. If you send me work, and students occasionally will send me work, make sure I can read it. It's hard for me to go in and try to give you some assistance if I can't read your handwriting. So one of the things I would ask is if you want to send me stuff, please do, but right where I can read it. Let's go to work. So we're going to talk about present value and financial accounting today in class, and I'm going to try to show you two different kinds of situations. Um, Remember what present value actually is. Present value basically is the situation where we take future cash flows and we mathematically remove the interest over the time periods. This is a mathematical computation. So if you're going to pay $100,000 in 3 years, then you can use present value to back out an appropriate interest rate and figure out what that $100,000 is worth today. And then over time, you can add the interest back in. So to me, it's a very easy idea. You take out the interest because of the passage of time. In fact, when I teach 201, I cover present value extensively, and the students all seem to do fine in that. I'm going to show you two different ways to use the present value, though. The first one is what we're going to do next week, and that is if you have a contract, usually a bond or a note or a lease. And in that contract, you exchange future cash for something right now. For example, a loan. You'll pay cash in the future, but you'll get cash now. Or you'll get a piece of land now, for example. So you have an exchange where there's an exchange of future cash for something right now. In that situation, all of the cash flows are known. I'm going to pay this and this and this. In addition, the cash interest rate is known, and we'll often refer to the cash interest rate as the stated rate. So in those situations where you know the cash flows and the cash interest rate, then present value should be fairly simple in the computation. Now, sometimes the parties can assume a different interest rate applies. So what happens is, let's assume I'm going to buy a piece of land from you, and I think, and the contract states that the interest rate is 8%. But for some reason, we believe that the real interest rate is different than that. Now, sometimes this real interest rate is referred to as a yield rate. I sometimes call that in class. Or it's a negotiated rate, or it's an effective rate. It simply means that the two parties have decided that even though the interest rate that is being paid is stated, the real interest rate is different. In those cases, you use present value. And so for those bonds, leases, notes, and the things like that, then we will cover those starting next week. However, tonight or today, we're also going to look at the valuation of estimated future cash flows. Now, that's not contractual. That's not part of the contract. We might do that to value a contingency. We might do that to value a warranty. Both of those are possibilities. So you have the need of a present value for valuation purposes, but it's not part of a contract. So, how do you do that? Well, the process is exactly the same. You take the cash flows and you take the interest rates and you back out the interest to get the present value. The thing that is different, the thing that you have to watch for in these cases is that the estimations might well change. And it is that change that's the problem. So you're just using estimations. So since you're just using estimations, the number that you estimate in the future year might be different than the one you estimate in the first year. So where we have a problem, and this is what we'll do in class, and so I'll make sure you see this, is if we're going from one year to the next, we've computed present value for one year, and we want to go to the present value for the following year. If none of those estimations changes, if the cash flows don't change, if the time periods don't change, if the interest rate doesn't change, just compute interest and add it in. We call that compounding. And that means that we take the amount of the liability, we multiply it times the interest rate that is being assumed to be the appropriate interest rate, and that computation is the interest for that period, and you simply add that in. We'll do that a lot next week. We'll do it so much you'll get bored with it all. However, there's a second possibility if you're dealing with estimations, and that is if anything changes, the cash flows change, the time periods change, the interest rate changes, then you must make a new estimation, and it is that new estimation that will bring the old balance up to the new balance. Now, I need to demonstrate that. I need to show you what I mean by that. I don't think that's clear until I explain it a little bit. But before we do that, the interest rate that we apply, and that's what we're doing here, the interest rate that we apply has always been something that accountants found difficult. What is an appropriate interest rate? Well, you'll find that there's a number of different appropriate interest rates. Here are a couple of possibilities that you might have to use at some time or other. Incremental borrowing rate means that if I was going to borrow that much more money from the bank, this is how much the bank would charge me in interest. I'm not talking about the amount of old interest or the old interest rates. I'm talking about if I was going to borrow that much more, the prime rate or the current rate, whatever people are borrowing for normally. And in class, we've talked about risk-free rates. A risk-free rate is kind of nifty because it's a rate that you can use anytime you need an interest rate. And the risk-free rate is the amount that you would get money for if you had no risk of default. And so what we mentioned in class is that we often use U.S. government bond rates as kind of a surrogate for a risk-free rate. So assuming that that's what you were doing, every company in the country could make that computation using exactly the same rate and give you a comparison in that case. If you need a more specific rate, we also have what's called a credit adjusted risk-free rate. And that's the risk-free rate, but you add on some interest for the amount of risk that the lender is giving you in that case. You'll see over the course of this semester that we'll talk a lot about interest rates. For the time being, I wouldn't worry too much about it. I'll just give it to you and say this is an applicable interest rate that the company would have in this situation. So you'll probably remember that in class on Monday, we left it off because we had a situation where we were trying to come up with the present value of a contingency. We had looked at the way that ranges are reported, and we had determined that GAAP allows us to use what we view as the better number. Now, that's specifically what it says. And we also said that in US GAAP, people have come almost universally to believe that that's not what it says, that what it says is most likely. But you and I read it, and we know it says better. But we were going to use a better number here. So if you remember from class on Monday, we had 100,000 that was possible at 25%, 200,000 with a 25% possibility, 300,000 with a 25% possibility, and 600,000 with a 25% possibility. But these all were in 4 years. So if we want to come up with a better number as the present value of the weighted average, then here's how we would handle this problem. The computation's always going to be the same. The present value is the future cash flow times the conversion rate. But the conversion rate is the key. And the conversion rate requires you to come up with three different things. How many time periods are involved? Of course, in this case, it was 4. An appropriate interest rate. I don't know where it came from, don't much care, but it was 8% in this problem. And the cash patterns, as we discussed in class, can be either a single amount, an ordinary annuity, or an annuity due. And we went over those, and be sure you know the difference, because this is basic stuff when you're finding present value. Is what's the difference in a single amount, ordinary annuity, and an annuity due. So for this problem, we took $300,000, which was the weighted average. The conversion rate was based upon 4 time periods. It was based upon an 8% interest rate, and it was a single amount paid at the end of that 4-year period of time. So when we did that, then we could go to the back of the textbook. They're available there. The conversion rate was 0.73503. So the present value right now, that 0.73503 is done in order to take out the amount of interest. When you do that, the liability is $220,509. That was in class. So the amount that we recognize as our better estimate is an expense of $220,509 and a liability of the same amount. Fine. We did that in class. That shouldn't be a problem. But what if we want to go 1 year in the future? Well, there's 2 possibilities. If nothing changes, then we simply take that same number, 220,509. We take the same interest rate of 8%, multiply that out to get an interest for that current year of 17,641. Now, what we call that interest kind of depends on the situation. I don't really care. As long as you recognize it as either a loss or an expense, I'm fine with that. As long as you know that, I'm okay. If it was a contract, it was probably interest expense. If it's a warranty, it's probably warranty expense. If it's a contingency, it's probably a loss. So it can be lots of different things. Don't much care as long as you record it as an expense. And therefore, your liability increases by 17,641. Now, if we're going to do this a second year, what we would do is we take the liability, we would add the 17,641, and that would give you, if I can make this addition, 238,000. I think I have that math right. 238,150 is the new balance. And then I would multiply that by the 8%, and that would give me the balance for the following year. And so you would simply do that over and over. And if you do that, if you do exactly that for 4 years, at the end of the 4th year, then the balance in that liability account should be 300,000 because you start with 300,000, you took the interest out, and then you put the interest back in. However, in many cases, the estimates will change frequently. So you have to do a new mathematical version every period. And then instead of just adding in the number, you have to adjust to that new balance. So if you do this for 4 years, you have to do 4 years of present value calculations. So in the problem we were having for today, the estimates changed. It was 100, 200, 300, and 600. They changed to 150, 250, 400, and 500. So we just do it again. Once again, they're 25%. We set them up, 150 times 25, 250 times 25, and so on. And that comes back, and you can check my math if you want. That comes back to 325,000. But that's the weighted average. We don't want the weighted average. We want the present value of the weighted average. So we go back through the computation one more time. This time, instead of being 8%, it's now 10%. Instead of being 4 years, it's now 3 years. And instead of being, of course, the 300,000, it's now 325,000. So you're just redoing the calculation. But do notice, it's not 4 periods now, it's 3 periods. So when I did this a few minutes ago, the conversion rate, and you can check it yourself, 10%, 3 time periods, single amount, 0.75131. That gives you 244,176. The old number, though, the previous number was 220,509. So your computation is not simply multiplied by 8%. Now you're going to adjust that liability from the 220,509 upwards to the 244,176, and you'll add in 23,667. Oh, that's not terribly difficult. I mean, you may not have done much of it, and doing a little practice is always helpful, but that's not terribly difficult. You can do that. The next problem we were going to do in class is to look at a couple of situations where we want to compare IFRS to US GAAP. And I just think that you need to have some knowledge of some of the subtle differences between IFRS and US GAAP. So here's the first one. The first one, you had a $10 million debt. It's 58% likely that you're going to lose money. So what do you recognize? Now, it doesn't say anything here, but let's assume that this is 1 year or less, because if it's 1 year or less, you don't have to do present value. So US GAAP, it's only 58%. In US GAAP, that is not considered probable. So in US GAAP, you'd recognize nothing. Remember that in US GAAP, we have always said it's roughly 70 to 75%. That's not shown to you in US GAAP, but that's how it's played out in US GAAP. It's kind of like the idea of most likely. It doesn't say most likely, but that's what people tend to do. It doesn't say 70 to 75%, but that's what people tend to do. IFRS, on the other hand, uses probable, uses exactly the same word, but probable is defined as anything over 50%. So therefore, under IFRS, you would have a liability that you would recognize of $10 million. Now, and the reason is simply a different definition of the word probable. Which do I like the best? You know, we've done this before where we had the refinancing, and I talked about whether I liked US GAAP or IFRS better, and I liked in that particular topic, I liked US GAAP better. Heck, here, I much prefer IFRS. If there's a 58% chance of a debt, if there's a 58% chance of a debt, I don't think you should recognize zero. I think you should recognize $10 million. I just think that probable is, if it's over 50%, if it were me, if it's over 50%, I would recognize that debt. I would follow IFRS in that particular case. In our second situation, we again have a $10 million debt. This time it's 85%. If it's 85%, that's probable anywhere, US GAAP or IFRS, but this time the payment's not until 10 years. US GAAP's kind of interesting. If they're talking about contractual cash flows, they will almost always use present value. If it's contractual. If it's not contractual, then US GAAP has stayed away. Now, there are cases where we decide that's a better estimate and we use it. But normally, if it's not contractual, deferred taxes, as an example, is not contractual. And so therefore, it's not recognized at present value. So therefore, if you owe $10 million and you're going to pay in 10 years, you recognize $10 million. You don't have to use present value. IFRS, on the other hand, and I think the book says that they only do this if it's material. Of course, in our class, we assume everything's material. So therefore, IFRS would simply recognize the present value of the 10 million. Now, that's going to be a pretty significant difference. GAAP will recognize 10 million. IFRS will recognize the present value of 10 million. Which do I like the best? You probably know the answer to this question. I think all future cash flows should be recognized at present value. So if you've got a cash flow in 10 years, it seems silly to me that you're not going to recognize it in present value. Now, I understand that makes a lot of computations, and that's somewhat costly to do. And I suspect that's why they haven't done it that way. I just think that with the power we have in our computers these days, recognizing present value would make more sense to me. And one final one of these IFRS versus US GAAP situations. We have a 10 to $14 million debt. I think the problem says that all the numbers are equally likely. It's in 1 year. I don't think it says, but let's assume it's probable. And again, the 1 year is there because then you don't have to worry about present value. Anything 1 year or less, you don't play with present value at all in that case. So it's 10 to 14 million. Well, we know what US GAAP typically does in these cases. US GAAP typically uses the $10 million because US GAAP has come to use the most likely number. And if no number is most likely, they will go with the minimum number. IFRS, on the other hand, doesn't have a most likely point. If it's a range of 10 to 14 million, like it is here, IFRS will just simply pick the midpoint, say $12 million, and recognize that. So again, you have a difference between IFRS and US GAAP. More than likely, US GAAP will recognize 10 million. IFRS will recognize the midpoint of 12 million. Which do I like the best? I've never been a fan of this minimum number. I just don't think accounting works well if you're going to recognize the minimum number. It seems to me, and again, this just to me seems like common sense. If you've got a debt between 10 and 14 million and you don't know what number it is, then either the weighted average or the midpoint just makes so much more sense to me that I just think that would have to be. So in this particular case, or this particular day, all three of these, I felt that IFRS was better. Don't always think that, but in this case, I did. Quick talk conversation about compensated absences. This is things like vacation pay, sick pay, where you earn something that you get at a later point in time, that idea of a compensated absence. And the case was pretty simple. The employee has earned a week of vacation for next year. Good for him. The employee is paid $2,000 per week now. The employee expects pay to rise to $2,200 before vacation. So you're going to get paid for 1 week of vacation. If you took it now, it would be $2,000. If you take it after the pay rises, it'll be $2,200. So what is recognized in this case? And I thought one of my favorite parts about this problem was, and it's in the handout, to go look at the footnote. And the footnote says that US GAAP doesn't tell you what to do here. US GAAP just doesn't tell you everything. I know that sometimes in accounting it seems like every possible issue has been solved. No, this is one where you can choose. You can pick the 2,000 or you can pick the 2,200. So let me show you how I would think about this, because I think this is kind of interesting. And maybe this is why they don't have a pick in this case. Let's go back to the three characteristics of a reported liability. Probable future sacrifice of an asset or service, past event creates a present obligation. If we focus on the probable future sacrifice, how much are we probably going to sacrifice? It seems to me that we're going to sacrifice 2,200 because it's probable, according to the problem, that we're going to wait until our pay raise comes into play and then take the vacation. So I think what the company is going to sacrifice probably is $2,200. So if you go with this line, it seems to me the answer is 2,200. On the other hand, you have a past event. You have earned the vacation. What is the present obligation? Well, the present obligation is clearly $2,000. They are obligated right now to 2,000. So just in my own thinking, the answer goes back to which one of those sentences or which one of those characteristics you think is more important. If you think the sacrifice is more important, then that's $2,200. Then no question. If you think the present obligation is more relevant, then that's $2,000. So maybe not, I don't know, but maybe FASB just couldn't decide which of those lines that they thought were more important. So they just left it up to you to do that in the case. Super. Now, I got one more thing to cover. And now we might in 1030 class or 130 class talk about a little bit about bonds. That's possible. But I don't plan to test on Friday on bonds. When we get to the next test, I'll test on bonds. So what I'm trying to cover here is what you might have on the test. So what I want to look at for this last thing is what happens when US GAAP rules collide. This happens occasionally where two different rules kind of butt up against each other and give you a different answer. And so the problem you have in your handout is one that I think is fascinating. Walgreens, of course, Walgreens, for those of you who might not know, is a pharmacy company or what used to be called a drugstore company, something like that. They have a contingent liability because they have been selling some tainted pills. Apparently, they've been making people sick, hopefully by accident in this case. So they're being sued, and they think the lawsuits are going to cost them between $1 million and $40 million, depending upon how guilty it turns out they are. They think they'll have a liability of between 1 million and 40 million. Now, these are US companies, so you know that they're going to take the or report the $1 million because no number in that range is most likely. At the same time, another pharmaceutical company, they've been out of business for a couple of years, named Rite Aid, has some of the same pills. So they have a contingent liability for tainted pills of, again, between 1 million and 40 million. You have two identical situations here, absolutely identical. And I assume that Walgreens will report 1 million and Rite Aid will report 1 million. And to me, that makes sense. It's two identical debts and they're reported in exactly the same way. Seems to me to be normal. But then what happens? Walgreens buys Rite Aid. That really did happen. They didn't quite buy it all, but they bought most of it. Well, back in 301, you've all passed 301, we touched on consolidation accounting. In consolidation accounting, the subsidiary, and of course that's Rite Aid here, its reportable assets and liabilities are added into the parent records based on fair value. So the accountant has to go crazy practically finding the present value of all of the reportable assets and all of the reportable liabilities, and that's a whole day's conversation. But that idea, you probably saw that in 301. Anything that was any excess acquisition price, if they paid more than that fair value, that was just assigned to goodwill. And goodwill, of course, isn't amortized, it just stays and it's checked for impairment. So when Walgreens buys Rite Aid, then Walgreens has to get its accounts to find the fair value of Rite Aid's contingent liability. Now, how do you find a fair value for a liability? Often what they do is they go to insurance companies and say, how much would you charge us to insure us against these losses? And that would give you a fair value. So if you have all these contingencies and you go to an insurance company and say, how much would we have to pay you to take over this liability? That would be the fair value. So let's assume we've done that and it's $28 million. If it's between 1 and 40, my guess is it's going to be closer to 40 than 1 because the insurance company doesn't want to be left holding, having a loss on this deal. So we're going to assume it's $28 million. Then what happens? I misspelled Walgreens there. I just noticed that. Walgreens now reports both of the contingent liabilities, the liability they had of their own and the liability they acquire from Rite Aid. And the liabilities are exactly the same, somewhere between $1 and $40 million. The one they have is reported at $1 million. The one they got from Rite Aid is reported at $28 million. Now, these two liabilities are exactly the same, but one, Walgreens, is reported at the minimum amount. The other, the one they got from Rite Aid, is reported at the fair value. And that comes up with two distinctly different numbers. And I find that just interesting that you can have the same liability on the books and one is reported at a very low number, and one is reported at a much higher number. So what that tells us is consolidation accounting here has priority over contingency accounting because that is not the contingency rule. That is the consolidation rule in that case. So that's about what we're going to cover on Wednesday at either 10:30 or 1:30. You can watch this a couple of times, and my bet is you'll know just as much as everybody knows who is in class. Hopefully, if you come to the 10:30 or 1:30 class, we'll be able to squeeze you in somehow. We'll do the very best we can to make it work out. But you have this fallback, this video. So what I'm going to try to do now is get loaded up on YouTube and send it out to you so you'll be able to watch it whenever you're ready to. Hope you're looking forward to the test on Friday. I have every confidence if you do the work, you can be just great. Best of luck on Friday. I hope everybody, whether they see the video or not, makes 100. Have a great night. As you can see, I'm having trouble getting it to turn off. But that's the worst problem I have tonight. I'm doing great. Here we go.